more important? Is it your debt to, which is more important? Is it your debt to income or is it your credit? My name is Sulondia Hammond, aka Suham Baby, with loanswithsuham.com, powered by Edge Home Finance. My NMLS number is 2519087. Now let's explore which one is more important. I'll let you be the judge of that because every scenario is different. Lenders are going to look at your DTI to determine how you are looking financially. So they look at how much income you have and how much things you have going out into debts, things like car payments, student loans, and credit card bills, and anything that shows up as a debt on your credit report. Please keep in mind that if it does not show up on your credit report, it will not be computed in your debt to income ratio, aka DTI, right? So if you're sending money to mama or daddy to help for the light bill or to help towards housing expenses, that's not going to be included because it's not on your credit report. If you're paying for college for a child or for yourself, that's a little different. If you took student loans, it would be on your credit report. And if it's for a child, if it's on your credit report. But if you're just giving them money every month and you're not paying the bill, you're not obligated to it, it will not show up on your credit report and therefore will not be included in your DTI. So why am I mentioning this? Because it's important for you to know what your affordability is, because we are only going to determine what your debt to income ratio is based off the income that you receive, all the income that you receive and can be counted. And we're going to look at the debts that's on the credit report. Credit score is important too. Yeah, because your credit score lets them know how you've been as a borrower. Are you paying things back on time? Do you have a good credit history? And if so, this could help you get a better interest rate. And we know that a better interest rate will lower your mortgage note, the amount that you send back to the mortgage company every month. Now, here is the thing. You can have a credit score of 842, but only have $1,000 coming in a month as income, and you're looking at a house that you have to pay back $1,500 a month. Well, in this case, your credit score is amazing, but unfortunately, you don't have enough income to sustain yourself and make a mortgage payment, so we would not be able to extend credit. Now, let's look at it a different way. What if your debt to income ratio is low, and typically to qualify for a mortgage, we want to keep the debt to income, if you're looking at an FHA loan, between 50 to 55%. VA does not have a standard debt to income ratio. It really just depends on the lender. That's why I always tell you guys, every lender is not created equal. So you want to keep your debt to income, I would say, no higher than 50%. All right. So now let's look at another scenario, right? We just talked about if you have a high credit score in the 800s, but you only have $1,000 in income, you're not going to qualify for a $1,500, $1,700 house note. It's just not going to happen because you're not making enough money. But let's look at it this way. What if you have a 620 credit score? You've got $15,000 in an IRA or 401k or stocks and bonds, and your debt to income is very, very low. It's like 30%. So that means that only 30% of your income is allocated to debts. Who do you think is going to get the mortgage? It's probably going to be the person with the 610, 617 credit score with the money in savings or retirement and less debt. So my advice to you is to keep your debt to income ratio low, right? Keep your income going in. This is why I don't do pre-quals. People will call and say, hey, this is my credit score. This is how much debt I have. What do I qualify for? And I'm like, there's no way in the world I can accurately tell you that without seeing certain paperwork. And this is another reason why I tell you to get all your paperwork saved on your desktop, on your computer, or on a folder in your phone, or put a folder on your actual desk with the paperwork you're going to need for home buying. And that's going to be your photo ID, 2 pay stubs, the last pay stubs you received if you're working a job. If you're not working a job, you're going to need to, and you're getting disability or retirement income, any type of income, will need to see proof of that. If you're self-employed, 2 years of your latest tax returns, 2 years of your W-2s, your latest W-2s, and 2 months bank statement. And then from there, we can go and we can determine if what you're pre-qualified for, what you're pre-approved for. excuse me, because I don't do pre-qualifications. I do pre-approvals, which is the reason why I need those documents. So in this, I know I've spoken pretty fast, trying to keep this down to 6 minutes. In this short video, I hope I have explained to you the debt to income ratio, the credit score, and how they impact a decision as far as a mortgage loan, and why you need to keep your debt to income ratio low and try to keep the income going up. All right. And that just applies in life, period. Whether you're buying a mortgage or not, keep your debt low, always be increasing your income. My name is Sulondia Hammond, AKA Sue Ham Baby with loanswithsueham.com. If you'd like to talk more about the home buying process, please reach out to me at loanswithsueham.com and book a free discovery call. Until next time, you guys have a great day.